What are you suggesting to clients that they do right now?
Well, I think that, in the context of some of the things that market participants have had to absorb in the last couple of months, risk assets have held up reasonably well. Yes, there's been massive pain, particularly in unprofitable tech and very long duration assets, and equities have pulled back. But when you consider how much inflation and interest rate rises investors have had to absorb, the war in Europe and growing risks of recession, they've held up reasonably well. But market sentiment has become very negative. And I think unless we get a deep recession, there's a limit to how much equities will fall from here, particularly given still very negative real rates.
Peter, when you sum Goldman Sachs economics into your legendary equity universe, all the different people that you're linking with in the sell side, your research analysts and such, what inflation number do we get back to? German inflation is unspeakable. American inflation is a different unspeakable. But what level do we get back to out there?
Well, I think our view is, and indeed I think the central bank's view and the market's view is that at least some of this inflation is temporary and will start to ease, particularly in relation to commodity prices and some of the supply side constraints that we've been seeing. Core inflation, of course, has gone up, but less so in Europe than the US, and there's less tightness in the labor markets. But certainly I think inflation is stabilizing in this cycle at a higher level than it did in the post-financial crisis era. And there's still a question, I think, about what the appropriate level of interest rates will be as we settle down at a lower level of inflation that we're seeing now, but a higher level than we've been seeing for many years, bearing in mind that real interest rates and nominal rates are still very low in the context of where inflation is likely to be. And I think that tension is still a key focus for investors.
Peter, does all this add up to being a screaming bull? Basically, are you saying to Tom, get out of triple leverage all cash and go all in on Apple, on Amazon? I mean, is that basically what this translates into?
I wouldn't say we would be really bullish. We are bullish of equities on a relative basis. We've got reasonable upside into the modest double digits over the next 12 months in most equity markets, because we think some of the tensions that investors are clearly focusing on and some of the uncertainty about where rates will peak and how weak economies will start to fade over that period. But I do think it's important to also put things in context. We've had years of strongly rising performance in financial assets, in equities, largely as interest rates have just trended downwards, and that's not going to continue in this next cycle. So we would be looking at positive but lower index returns, and much more focus on alpha, much more differentiation beneath the index levels of equity markets within and across sectors.